The only difference between 2007 and 2022 is the miners are not trading as high as the tech companies and the other sectors.
There was just now this morning came out the announcement of inflation at a 40-year high. That the Dow is down another 800 points. One of the worst weeks, one of the worst months, one of the worst years on record, and people are seeing the impact of inflation in many real areas of their lives. Fuel prices, prices they have to pay for repairs or parts, prices they have to pay for labor. All of those kinds of prices that we just mentioned affect mining companies as well. So as potential investors, people are very concerned about the impact that inflation is having on the mining companies. Perhaps most notably silver mining companies, because silver, ironically, on the other end of the spectrum, seems to be one of the very few things in this world that is not participating in the everything bubble. We've had the simultaneously bubble of stocks, bonds, real estate, many commodities over the past several years, and yet silver seems to be stubbornly holding out as far as not having regained its previous nominal highs in most markets. And so as a silver mining company executive, our subscribers are wondering, how are you being impacted by inflation as a mining company manager?
Okay, great question. And the way I'm going to answer that is I'm going to take a longer view. Okay, so when you're a mining company, we look at 3-year trailing prices. Okay, so if, for example, I just purchased a project for Dolly Varden called Homestake Ridge, and we brought it into the company. So this project has a preliminary economic assessment. So when the preliminary economic assessment was published in 2020, they were using 3-year trailing prices. Guess what the gold price assumption was, and guess what the silver price assumption was?
I'll go $1,450 for $1,500 for gold, and for silver, oh golly, man, I'm gonna go $18 an ounce, something like that.
Very close on the gold side. The gold assumption using a 3-year trailing price for a 2020 report was $1,350. And for silver, this price assumption was $12. And so I think what happens when it comes to investors, we look at today, we look at, okay, the CPI print, highest in 41 years, and then we look at the gold price and we go, or the silver price, and why isn't it immediately reacting? But I got to say it is. And as we take as we build mines and we take these longer term outlooks, look, everything is setting up nicely. If we go back to 2007, we were at a very similar time. We had record oil prices. The oil price was up at $140 a barrel. All these equities were at record highs. The only difference between 2007 and 2022 is the miners are not trading as high as the tech companies and the other sectors. So the opportunity going forward this is actually more like 2002 than it is 2007. And you go back to 2002, you go back 20 years, the miners were at the bottom basement level. And so we are seeing now the Dow's down 10 out of the 11 last weeks. The miners are up today. The miners are doing well. You go back to April 16th, April 17th, Newmont was putting in 52-week highs. So you can't look at these things like there's no immediate correlation between an inflation print and the gold price. But go back to, and I talk about gold as much as I talk about silver because there is that relationship and they're together. But I go back to the idea of, let's go back 100 years. Ounce of gold's worth $20, right? And you have a $20 US bill, right? That ounce of gold could buy you a night at a fine hotel, a good dinner, a nice food, and it still does those 3 things today, whereas that $20 bill barely pays for the Uber to get you to the restaurant. So I think we have to take long-term outlooks, and as miners, look, the Rick Rule says it best, the cure for higher prices, the cure for lower prices. I remember when I first got into the business 18 years ago, I was in my early 20s, and I remember the cost of production for the average producer was about $225 an ounce. And they were using gold price assumptions of $300. So companies would market, hey, we could make $75 an ounce on every ounce we produce. And what if the gold price went to 500, 600? What if we got an inflation adjusted gold price to 16, 17, $1,800? And what happened? Well, the cost of production went up. And so to me, gold and silver are mirrors, okay? And they're just going to reflect what's happening in this monetary debasement. And if you want to protect yourself, keep it simple, get some physical gold and silver. If you're more of a speculator, buy mining stocks because they're going to outperform the metal. But I guess my answer is let's look at long-term outlooks. Let's look at long-term prices. And, on the silver side, let's focus on projects. Like just to the north of Dolly Varden is a project that Hecla operates, Greens Creek. And a few years ago, the cost of production there was $4 an ounce of silver. So even though if you had $12 silver, Hecla could still make money at Greens Creek. So let's focus on grade. Let's focus on safe jurisdictions. And no matter what prices of these metals, you're always going to be able to make money. And that's how I try to run the business.
Something that you just mentioned about the long-term preservation of purchasing power that metals offer brought back a very vivid experience myself. I just celebrated my 60th birthday, and one of my earliest memories from childhood, and we just came back from a long road trip was long road trips. And on a long road trip to the southern coast of Texas in 1968 or 1967, there was a price war going on with gasoline. It was 19.9 per gallon, 19 cents, 0.9 per gallon, which you can think of it as 2 dimes. Those same 2 dimes, as we sell them today, silver dimes, 90% silver dimes, going for over $4 today for 2 silver dimes. And just thinking about that is like I can pretty much buy you a gallon of gas today, even though all that has gone by between now and then. So the preservation of purchasing power that precious metals promise and deliver decade after decade, century after century is remarkable. You've got some pretty expansive plans, and a lot of companies that are in the mining business have to go for the sweet spot when the weather permits and so on to do a lot of expansion of their drilling programs. You have some 2022 drilling programs in progress. Can you talk to us about what your goals are for that, what the scope is of that, what you're trying to learn through the drilling program this summer?
Yeah, great question. So we're a company, and just before I talk about this season, I think it's important to give you a little bit of context. So if we go back 2 seasons, we were a $20 million company that had 44 million ounces of silver in the ground. And my vision, my goal was I wanted to bring as much high grade, high quality silver and gold mineralization in our mineral inventory, because the trend that I saw was the majors are not replenishing their mineral inventory. And my thinking was, for these majors to grow their production profiles, they're going to need to acquire companies like Dolly Varden. So why has the share price tripled over the past 2 seasons? Why has the market cap gone up by 600% at a time where most of my peers are flat or down? And it's because we've grown our mineral inventory. We've done it through discovery, and we've done it through acquisition. So we now have 138 million ounces of silver equivalent in the ground. And my goal this year is twofold. I want to expand and extend known deposits. So our mineralization is made up on 7 deposits. So I want to grow that. And I think we can incrementally grow the existing resources by about 30%. That's typically traditionally what happens with mining operations. They're open at depth, they're open along strike. I could get a little bit more promotional and give you some greater numbers, but conservatively, I think that's what we can do, which is material. But the big opportunity lies, and this is where I'm allocating 50% of our budget to try to make a new discovery. And we've got an area, it's measured in kilometers of about 5.5 kilometers in between 2 of the mines, to the existing deposits. And we are trying to make a new discovery within that 5.5 kilometers. And that would really move the needle. That could potentially add 50% or 100% to the mineral inventory. And so the big goals here are to de-risk, to expand, to grow at depth and along strike, and secondly, to make a new discovery. We have $25 million in the bank. We have no debt, and we've allocated a $12 million drill spend for the 30,000 meters. The program has started. There are 3 drill rigs turning, and we will have drill results. And that's what's really going to drive the value of the share price. If we can, 2 things will drive the value. If we can add mineral inventory, and if the gold and silver price rises. And there's 2 ways I know to add inventory. One is through the drill bit, through discovery, and the other is in the boardroom through acquisition.
We have a question submitted by a viewer, and this at different stages of mining and exploration and development and operation companies will find different answers to this question. The question is, when do you see giving a dividend?
That's a great question. I think Dolly Varden's fate is going to lead us into where we are acquired by a company that potentially pays a dividend. But I think, like for me, the reason we've seen so much growth is our strategy as an advanced explorer. We are a pre-revenue company, and so for us, it's not in our immediate business plans.